Has the computer become your new financial advisor? We'll see how quickly wealth managers can evolve to keep up with the digital age. Plus, we'll do a deep dive into the world of hedge fund fees. This is 7-Day Yield. Welcome, I'm Mitch Rochelle.
And I'm Haley Zimring, and let's see what's trending. According to a recent PwC study, more than 1/3 of organizations have experienced some form of economic crime in the past 24 months. The study, which included more than 6,000 respondents, showed that while economic crime is significantly changing, detection and control programs are not keeping up with the pace of change. In fact, 1 in 10 economic crimes are discovered by accident. While as unpredictable as cybercrime is, the housing market is just as dicey. Monthly new home sales soared from 520,000 in March to nearly 620,000 in April. This 16.6% surge was the largest percentage increase since January 1992. And one last trending headline today, a recent PwC study says that while 69% of high net worth individuals are using mobile banking, only 25% of wealth managers are using digital channels beyond email. In fact, PwC partner Michael Spellacy was quoted saying that wealth management as a sector is essentially the least tech literate of all financial services. So Mitch, very quickly break this down for us. What's the biggest takeaway here?
What's interesting, and we have an upcoming interview on the topic, they'll use this to bank, but they won't use that to trade stocks and bonds. So we're going to have to figure that out. Nidhi Sinha recently sat down with Michael Spellacy to find out about the future state of wealth management. Take a listen.
Michael, this is a fascinating report, and I read this a lot this morning, and one of the things I was immediately struck by was this idea that somehow there is a group of people who are not embracing technology. How does that happen? Tell me a little bit more about that.
It really is. There's such counterintuitive and contradictory pieces in this report. It's quite fascinating. I think the thing to remember here is that after 20 years of doing this report in general, PwC has gone out on a limb here a little bit to explore the mindsets and the behaviors of clients. So this report actually gets into what do clients actually want, what do they desire, and how they behave and interact with their wealth management institution. And so to your question, what's fascinating is what we've discovered is that while the majority of people interact with their financial institutions digitally or online, well over 70% of participants respond in that way, what we also see is that roughly around a quarter of them, 25% or so, unfortunately do not interact in any way, shape, or form with their wealth manager online. So that you essentially have a very, very large gap between what people want to do and what they're capable of doing with their wealth management institution.
What is it that's specific to wealth managers that they're not able to bring the digital part of what they do sort of outside into their relationship with their wealth managers?
Well, I think wealth managers have a very unusual client proposition in that they're oftentimes the store of a very, very personal relationship in a very authentic way. So that the client's goals, their life, their ambition, the health of their wealth is contained within a physical interaction with an actual wealth manager. And what we see in this report is that clients today want far, far more than that. And unfortunately, a lot of wealth managers have become very complacent. It's a very big industry. It's a fast-growing industry. They've become used to high growth, high profitability, high reward, and very little reinvestment in what's actually required to meet the needs of the client going into the future. The world around us has changed dramatically over the last several years, and now we see over 40% of all high net worth clients that we interviewed, and it carries across the industry, across globally in fact, interact with execution only or robo-type investors for their money, and much of that is away from their current interaction and current relationship.
And tell me a little bit more about the human side of this, right?
Sure.
I mean, we're talking about these relationships which are built over, decades probably. At what point do you let go of that human side and bring in technology? Or is that supposed to happen? And do you think that's going to happen anytime soon? I mean, the report does talk about potential.
I think we're striking into the heart of what is the future of advice. What does it mean to have a trusted relationship? What does it mean to interact with your advisor, both in the interaction between technology and in physical or personal interaction? I don't think you'll ever truly replace the personal interaction that an actual customer has with an advisor, but you can certainly augment it, expand it, deepen it, widen it by engaging in a much more technological sense than what they're actually doing today.
What else should we look out for from this report?
What really jumps out, I think, the big 2 points are quite simple, but very, very provocative and profound in terms of its implications. Number one is there's an incredibly low sense of digital adoption amongst wealth managers today. Only 25% of wealth managers interact digitally with their clients. That's really appalling in today's world. The second one is that there's very low advocacy of their current clients for that institution. So in many cases, roughly 35 to 40% of clients would recommend their wealth manager. That's a big shock to a wealth manager because their business prides itself on referrals and growing its own network of individuals. And when you get over $10 million in assets, only 25% or so of clients would recommend their current wealth manager. That's the highest growing, fastest segment in terms of profitability for wealth manager, and the fact that only a quarter of your clients would recommend you as an institution is a big shock.
Is there anything else that you think about when you look at the future of advice and what that looks like that we should think about too?
I think what we should really think about it as an industry, as a set of advisors to the industry, and as a set of participants in the industry, is that it's very easy to view this in doom and gloom circumstances, that it doesn't work, it doesn't work, it doesn't work. I think we really have to look at the other side of the equation in terms of what does this mean as an opportunity. It's really a call to action to engage in a much deeper relationship with your clients in what they actually want you to do. They're asking for this. They want to engage, they want to have a much deeper and wider and more thoughtful interaction and a relationship with you, and therefore it's all up for grabs at this point.
And Nidhi joins us now. Nidhi, thank you for being here. And the number that really stuck out to me in that interview was that only 25% of clients would recommend their wealth manager. How do you react to that number?
You know, Haley, one of the things to really think about, and let's boil down this report in just one sentence here, I'm going to oversimplify, but the dramatic difference in the culture between how the clients are looking at technology and how the relationship managers are looking at technology, I mean, it's really astounding. So when you're thinking about recommending your wealth management company, that's going to come into play. You're going to think about, would I recommend this if you are the person who's looking for more technology? So when you think about why that is, and you want to think about how that's going to change or what the future is, you want to think about the opportunity for wealth managers, because suddenly you have this industry and this dynamic where clients are looking for more technology, and the resistance they're feeling is from the company itself. And so where is the opportunity? It's for the companies, for the wealth management industry, it's for the relationship managers to bring that into play.
Nidhi, I think we're going to have to leave it there. When we come back, we're going to be diving deep into the world of hedge funds. This is 7-Day Yield.
Your daughter has a brilliant idea for her science project, and you could make it happen, right? Wrong, because you're not you. You're a cancer hospital, and your daughter, she's a team of leading researchers. And that brilliant idea is a breakthrough in patient treatment that could save thousands of lives, which means you need a diverse team of advisors helping you, from research data analytics all the way to transformation of clinical care. So you call PwC, the right people to get the extraordinary done.
Welcome back to 7-Day Yield. I'm Haley Zimring. The private equity and hedge fund worlds use the term 2 and 20 when it comes to fees. But what does it all mean? PwC's John Toscano and Liz Diep broke it down for us.
Arrangements for hedge funds and private equity funds. Would you mind just taking a moment and describing what that means?
Yeah, absolutely. The 2 and 20 fee structure is typically what we see hedge fund managers and private equity fund managers get compensated by their investors. So the 2 represents a 2% management fee on capital that the limited partners pay the general partner for overall investing activities. And what this fee is meant to be used for is really to keep the lights on at the fund, right? To pay for expenses such as salaries and for the overall management of the fund. Now, the 20 comes from a 20% on performance fees. And that performance fee is meant to be really where the general partner gets compensated. This is where they really work for, John, because this is where the majority of the compensation comes from.
Use the words general partner and limited partner in what you just described there. Would you mind just taking a moment and explaining what those mean? Yeah,
in the industry, in the hedge fund and private equity world, what you typically see is that a lot of these structures are partnerships. In a partnership, you have a general partner and a limited partner. The role of the general partner is really to be the manager for the fund. So they are responsible for making the investment decisions, for hiring personnel, and for making sure that the day-to-day operations of the fund goes well. Now, the limited partner, you're essentially the investor, right? And so you provide the capital through which the general partner is able to make investments on behalf of the fund.
You also described the fee arrangements as typically being set up as a 2% and a 20%. Now, is that to say that it's always going to be a 2% or a 20%, or there are circumstances where you may see the limited partner coming in and perhaps negotiating different fee terms or arrangements?
Yeah, that's an absolutely good question because that's a new trend that we're seeing in the industry. What you're seeing that 2 and 20 is no longer 2 and 20. What we're seeing is that investors are really negotiating different fees because the research has shown that hedge funds and private equities are not always beating indices such as the S&P 500 or the Dow Jones Industrial Average. And so what we're seeing in some of the data is that the 2% management fees is now averaging about 1.6%. So more to come on that as investors are really getting smart around the opportunities that they can get individually.
One other thing that we hear is this concept that the 20% fee arrangement is meant to align interests between the general partner and the limited partner. Would you mind maybe just elaborating a little bit on what that actually means?
Yeah, that alignment of interest absolutely must exist there. The reality is that when the GP wins, the LPs win, right? So when the general partner gets compensated on 20% of the profits of the fund, if we have high returns on the fund, the general partner will receive higher compensation. But at the same time, as a limited partner, our returns on our invested dollars become fairly good. So it's really a win-win for all to have those high profits earned any given year.
PwC tax partner David Levitt joins us. David, Liz was talking about the 20%, which is also known as carry, but for some reason carry gets a lot of attention in the media and amongst politicians. Why so much political attention for carry?
I think taking a step back, Mitch, the purpose of the carry is that essentially it's given to different promoters of partnerships to incentivize their entrepreneurial nature to go out and form these different partnerships, whether it's in real estate or hedge funds or private equity. And the nature of what we call a carry or a promote is that essentially you earn money from the partnership of which you're the partner in, and the underlying income that that partnership earns, whether it's capital gains or ordinary income, retains that character in the hands of the partner. So one of the reasons why it gets so much political attention is that many times these particular general partners of the funds who are receiving the carry essentially get something in return for the services that they provide. However, generally, when people provide services, it's usually taxed at ordinary income rates. However, because Congress recognized the entrepreneurial spirit of these individuals and wanted to incentivize the creation of new businesses, it said that the carried interest would essentially retain the character. So if the partnership receives capital gains, then the general partner receives capital gains. So they're taxed at a lower rate than they otherwise would if they just received ordinary income or compensation income.
So it's the tax rate on the profits that's getting all the political attention.
It is, and it's easy pickings. If you take a look at the current climate and everything that's going along with that, it's very easy to sort of target these individuals who are earning these. But I think you forget, once again, that they're taking risks as well. And the purpose behind the carry itself was to recognize this risk and reward these people for the risks that they're undertaking.
Great. Thanks so much, David. On our next show, we'll dive deep into the world of alternative asset classes.
Thanks again for watching. We'll see you next time on 7 Day Yield.